I want to talk about the fact that Charlie Munger died.
Yeah.
Charlie Munger died?
Yep, that should be at least a mention. If anybody's going to get a mention on here, it's going to be Charlie Munger, not freaking Tyler Swift.
I am so sad.
I know, dude. It sucks.
Like if I'd seen it a little earlier, we probably could have pivoted and done a little, whatever on it. But I don't know. I mean, I know.
When did that happen?
Sometime today. I mean, the dude's 99. I mean, it's not like they could, but.
Oh, okay. We're dedicating this episode to Charlie Munger.
Yeah, 100%.
Welcome to Drunk Real Estate. Grab a drink and enjoy the show.
Hey there, and welcome to episode 25 of Drunk Real Estate. Quarter away to 100, boys. I feel like that's a pretty good accomplishment. I am Kyle Wilson, Ashley Wilson's husband, and I got all three of the boys on the pod here, starting with Mr. Jay Scott. How's it going?
I am doing well. I need to start here real quick. I just realized something. Michael Warthen, 1947. That's a YouTube handle. I owe him a book, and he sent me an email a couple of weeks ago, and I never sent him a book, and now I can't find his address. So I'm going to take some of my time here to say, Michael Warthen, 1947, send me another email with your email address. And if you don't hear this, well, then you don't get a book. There you go. That's my intro.
We just lost half of our audience, but that's okay.
Well, to plug that sometimes people get books if you listen closely.
Exactly. And sometimes I forget to send them.
Jay, what are you drinking tonight?
I am going with another YouTube person who suggested I drink a Chilean wine. So I went out to Total Wine and got this Cabernet numero 8. I don't know if that's how you say it. But apparently it's a Chilean wine from the Maipo Valley.
Mauricio's looking very skeptical of this.
That's already sketch. First of all, I know that the person who recommended that is actually in Chile. So, and then you went and got that thing from whatever it's called.
It's like they had 3 Chilean wines.
Did you spend $3 on that, or?
No, it was like $25, $26. It's actually really good. Spicy.
Well, Mauricio, what are you drinking to show him up then?
I am drinking a Spindrift raspberry lime and with real squeezed fruit. Check it out.
The hell is that?
It's a sparkling water, unsweetened.
There's no alcohol in that, is there?
Dude, I just got back from my 10-year anniversary with my wife and at this amazing resort. And let's just say we had a good time. So I was like, I need to get some water. I need to rehydrate. And so I'm drinking the sparkling water today.
Wow. Not only do you have to leave early, but you don't even show up with a drink.
I drank more this weekend than for the rest of the year.
I'm starting to question your commitment to this, Mauricio. I'm, you're on thin ice. That's all I'm saying. AJ, how's it going over there?
It's going good. Well, unlike Mauricio, I stayed true. I've got my fountain drink, the Diet Coke, so not fully leaded.
In the red Solo cup.
The red Solo cup. And it is wonderful.
How come AJ gets a pass? Wait, AJ gets a pass, and I'm like, what's going on here?
Well, AJ, our designated driver. We don't need 2 drivers. Jeez.
I'm staying consistent here, man. You're the one that's veering from the path.
You still haven't lit up your dinosaur in the back, though, so I'm still holding out hope that you're going to do that.
I know. We're trying to get those lights in there, the like battery powered ones.
Yeah, come on. You got enough. Assistant number 42 should get on that.
It should. Take a note.
All right. You seeing this, guys, what I'm drinking
Woo,
tonight?
look at that.
Yeah,
That is fancy.
Wow. Hey, Jay, check this out.
Nice.
You hear that?
Wow. Does Ashley know you're doing this? Does Ashley know you're doing this?
Well, because we have 2 bottles now, because Miss Ashley Kerr came and visited, and her and Daryl brought us a bottle to say thank you for staying with us. I took them to the Eagles game. It was a rain out, but we pulled off the win in the end. Probably the best game of the year. So I'm not even mad that it rained. It was awesome.
I can't believe you guys went to a football game in the rain and stuff. It's like
commitment, just like this podcast. You commit to drinking because it's called Drunk Real Estate. That's what. Obviously, you don't know what that means.
You guys are boring me. Let's jump in.
Well, we're starting with Mauricio. Let's start off. I'm going to eat a little bit of crow here. I was predicting that we would have super low holiday spending season because we had record high consumer credit, and credit card balances were record highs, and student loans were restarting. So I thought that that this was going to be a super low spending season. But then CNBC just reported that Black Friday shoppers spent a record $9.8 billion in U.S. online sales, which is up 7.5% from last year. So, Mauricio, let's start with you. Did I just get this completely wrong?
Dude, I don't have a good answer for you on this one. I was pretty flabbergasted, if that's a real word. I'm sure Jay will come back with some economic statistics to back this up. But, there's been a lot of talk about everybody being maxed out of credit cards, right? There was an article in the Wall Street Journal called American Borrowers Are Getting Closer to Maxing Out. And it basically was showing how, we've been talking about this podcast a lot, where savings has started to come down. People are running out of the savings. It basically almost hit zero. And now it looks like credit card has been basically maxed out. I mean, credit cards grew, the loan grew almost 19% annually, about 1.6%, which was like double what it used to. The delinquencies have tripled. The net charge-off, which is what the credit cards have to write off for bad debt, that's quadrupled. Those living, below, those have that below average incomes of 50 grand, their delinquency is like 80 and 90%. I mean, it all looks horrendous. The Fed has come out and said, look, the lending standards continue to tighten up. They're not, they're really tight on credit cards. Credit card interest rates, I don't know if you guys know this, some of them will go over like 30%. It's like insane. Student loans, right? We've been talking about student loans coming back on the rest. And then yet freaking the consumers out there buying on something. Like, I don't have an answer. I'm hoping you guys have an answer, because it just doesn't make any sense to me, unless people are just so, I don't want to say irresponsible, but they're just like, they're at 90% maxed out. So now we're going to be at 95% maxed out. I mean, I don't understand where all this is coming from. So I'm obviously missing something, and I'm sure there's gonna be a lot of comments in this saying, you don't know what you're talking about. But with the savings rates coming down, credit cards maxed out, I would definitely have predicted, nothing great on the Black Fridays, but maybe it was all front loaded. Maybe everybody just went out and bought everything on Black Friday and Cyber Monday, and now they're not going to spend anymore. But we'll definitely see the final stats this year. I know, Jay, you've been talking a lot on this podcast that you think this holiday season is going to be a big kicker, because there's a lot of these companies have huge inventories, and they need to draw those inventories down. And the question is this enough to get those inventories down so they can start spending again? And if they can, that's going to be a drag starting in Q1. But Jay, I don't know if you've got any insights on that, but it's just really, when I saw that article about maxing out, and then I saw the article on Black Friday up, 7.5%? It just, the numbers just didn't add up, and I just couldn't quite figure out what in the world's going on. But Jay, I'm sure you've got some thoughts on it.
Well, I mean, the interesting thing here is that we're not the only ones who are confused on this. So a couple of weeks ago, I think right after the last episode we recorded, the next day, an article came out basically with the Target CEO saying that he was expecting that things were going to drop off this season, that he expected disposable incomes to be reduced, and that this was going to be somewhat of a muted holiday season. He didn't say if he had data to support that, or if it was just a personal opinion. But clearly he was wrong. And I think a lot of people have been wrong, because again, we've heard a lot of people say that this holiday season could be a bust. And the funny thing is that when you look at the brick and mortar sales, like you look at Black Friday, they were up, but they weren't up nearly as much as the Cyber Monday. And so it looks like, and after Black Friday, everybody said, it's going to be a relatively robust holiday shopping season, but nobody realized exactly how robust it was going to be until earlier this week. And so I think that a lot of people are just going online and spending online. And I think part of it, I mean, I'm just making this up, but I think part of it is just because it's so easy. I mean, if you have to get up out of bed and actually drive to the store and shop, there's some activation energy required there. But going online and just putting in a credit card and buying stuff is easy. And so I suspect that people are just shopping without thinking about it, and they've gotten into this habit over the last couple of years. And I still think, give it a couple months, and we're at that cliff.
Well, I'm going to double down here, and I'm going to say, so what do you think that the 2023 total holiday retail sales projection is for this year. So I'll jump in and say it's 957 billion. So we're only talking about, like, the Black Friday sales are only talking about 10% of that. And I'm going to double down and I'm going to say Black Friday was so good because people have less money right now and they're preemptively trying to take advantage of all the sales, because if they can't take advantage of the sales, they probably won't be able to afford everything they want for Christmas. That's the only thing that I can think of that's going to explain this.
That's a reasonable, that makes, at least to me, it makes, yeah, that makes logical sense. Because the percentage wise, it doesn't matter because the percentage year over year was up. So compared to whatever the percentage was from last year, we've been the same. But no, that's a good point. I mean, obviously if money's tight and, you got to be a little bit more conscious about how much you're spending, that would make sense. That's the only thing that makes sense right now. So, I mean, the other, by the way, yeah, I'm glad you brought that graph up, because the other stat that was, I think CNBC was coming up with this, where it said that like half of Americans rely on credit cards to meet their monthly expenses. So like 48%. So, I mean, clearly they're relying on credit cards. Clearly that credit card is getting maxed out. It just seems really, I don't know, you would just think that they'd spend like one less Christmas gift or something, or just a little bit less if they're getting, if they're already relying on credit cards and about to max out. But anyway, Jay, you've got this household debt payment on there.
Yeah, and so I think this tells part of the story, and it's pretty obvious when you think about it, but we don't think about it enough. So the chart for those that are watching or those that aren't watching is basically household debt service payments as a percentage of disposable personal income, and what we see is that we're somewhere around 10% of disposable income for the average American being spent on mortgage and credit cards, or mortgage, credit cards, and other revolving debt. And so what we see is from this chart, if you go back to like 1970, I think this chart starts 1975, for the most part, it's always been above 10%. It dropped to about 10% back in 2012. Stayed right there until about 2020 when it dropped really low during COVID, but now it's back up to where it's been since about 2012. So the question is, what happened in 2012 that made the percentage of disposable income spent on debt drop below where it had been for the previous 30 years? And for me, the answer is obviously that mortgage payments have dropped and interest rates have been so low for the last decade. Most people that own a house right now are still paying in the 3-4% range. And so people are paying so little, or have been paying so little on their mortgage over the last 10 years, that they have a lot more disposable income to be spending on credit cards. And so that to me is kind of the factor that's we don't talk about enough, is that people have a set amount that they can spend on their debt, and they're spending a whole lot less on mortgages these days. And so they're spending more on credit cards and other frivolous stuff. And I see AJ shaking his head there.
No, I agree with pretty much all that, meaning that it's a decision. So household expenditures it's a bucket, right? So we're making a decision on where to pay or not. Incomes are up, are the relative amount that we're allocating towards our homes, everything else is down, historically speaking, right? Low interest rates and fixed interest rates and very, very low. So over that time, if you take the last 6 years, everybody that purchased and has fixed debt at 3%, and your income has been rising at 3% every single year from that, which we had 2 years where incomes rose a lot faster than that. All of a sudden, that spread that's a big spread, because we're talking about the allocation to little things, meaning that now we're expending online. I'm buying gifts, right? Where we're not buying houses right now. We're not buying cars right now. So car sales are plummeting. House sales are plummeting, right? So I think it's not even so much that they're in great shape or anything else. I think it's just a decision, meaning they're deciding on one thing rather than another. And I think that we're still maxing out, right, debt. And I think it is still running lower. But I'm going to be more interested, as was mentioned before, what the total spending of the fourth quarter is. So not just on one day, right? Not just cyber, because also retail, like walk-in, was crazy down. The amount of people that were actually going to the store was a fraction of what it used to be. So even though we hit record sales online, did that make up in retail in-store traffic? Did that make up for retail same-store sales that we saw in years past, which were, I mean, the reports on people actually going into the store, and it's Black Friday was fizzled out, right? There were no lines, there were no anything. I mean, I had to go out, which I hate shopping, but I had to go out. I was shocked. I was like, oh, this isn't busy. Nobody's out here. So I think that too, the question I have is, are they deciding, and it's just a major shift in change of purchase, right? So basically, I think the question that not Jay and all of me, are we swapping spit here? That it's actually not a boom in consumerism. It's just we're changing how and when we're spending the money and what we're spending the money on.
Which means the other 40% don't have a house, they don't have a mortgage, they don't have that option of, well, I'm going to spend less money on the, I have a low mortgage payment. They've just got rent payments, and rents have been going through the roof, right? And gas has been going through the roof. And I think those are the ones that are, those are the 50% of Americans who, rely on credit cards to do their day to day. So, I don't know. It's still, but I agree.
Jay, did you have the online versus the in-person stats? Did you see that before?
I don't. I did see that online was 38 billion. I don't know if they've released in-person sales yet, but online was 38 billion, which is up about 8% over last year. They were expecting about a 5% rise over last year, and it's an 8% rise over last year, which I know these seem like relatively close numbers, 5% versus 8%, but that's 65% more increase than what was expected. So it was a significant online. Let me see if I can find.
Maybe the other argument, I'm sure I would, if I went into Twitter and looked at some of the folks that I like Peter Schiff, I'm sure somebody like a Peter would probably say something along the lines that, inflation has something to do with that. Like these are total nominal dollars, right? So
well, yeah, even if you knock that down, the online sales are up 7.5%, but inflation was over 4%. So that's the real rise isn't as high. And I agree with AJ that most likely the in-person sales are way down. So if that brings it off a little bit, maybe these numbers aren't as compelling.
Well, and it's a change of habits and how we work. COVID changed the way we buy. So after everybody had 2 years of not going out to the store on Black Friday and stuff, I think it obviously shows like, I don't need to do that. I'm not done anymore.
You don't want to stand in line at 4 a.m. And get a little tent and wait for 4 hours before Best Buy opens?
My definition of hell. That's it. An eternity of shopping Black Friday.
You didn't used to do that? I used to do it all the time when I was like 13 years old. I loved it.
Yeah, you also go to football games in the rain, so you're a unique specimen.
Hey, there was tens of thousands of people there with me.
You're not the only crazy one.
Well, what's the definition of crazy if we are all doing it?
So they don't yet have Black Friday sales numbers for brick and mortar, but they are saying that the number of people that shopped in store on Black Friday was up 2% from last year, after being up 8% the year before. So
that's because COVID numbers.
Yeah,
So we got to go back pre-COVID to see, because it's up 8% from a year where we had lockdowns. So that's we're going off a really low baseline.
And who knows how much they spent too, right? That's just the number of people.
Yeah, we don't have the number. We don't have how much they spent. We just have the number of people.
Well, we'll have to do a follow-up to this and see if our theories are right, that maybe Black Friday wasn't as robust as we thought it was.
Well, the other thing to keep in mind is that, and I don't know the numbers, but it's the majority of the holiday money that's spent is not on Black Friday. Not saying that for any given day it's not the largest amount, but if you take the total amount spent over the quarter, Black Friday doesn't account for more than half of that. So I mean,
yeah. Well, actually, I said it before. It's about 10%.
Yeah. Okay. So it'll be really interesting to see. I mean, there are those people that like to shop on Black Friday, and who knows, maybe they're blowing their wad on Black Friday sales, or what they think are Black Friday sales, and now they're going to slow down considerably, and maybe we're not going to see much after this. Now, we said that 2 weeks ago about Black Friday, and look where we are. But maybe now this really is the end.
That is another thing. I think we also see in the economy, though, where the economy is being hit. and it is way more isolated, meaning that interest rates are affecting certain segments of the economy and not others, meaning that the consumer for these normal activities, right, it still seems to be strong, where once again, the larger purchases, the debt fuel purchases, right, those have just cratered. So right now we have a weird economy where interest rates, it's been the ongoing problem. We still haven't seen it trickle down into Main Street yet. That's the Fed's problem, right? They're like, this hasn't affected Main Street. We're not curbing a lot of that appetite, which has been very, I think, interesting for everybody involved, where it's like, how long can this keep going on? But it seems to be very persistent.
Well, in the timing might have been a little bit fortuitous too, right? Like in the week leading up, that's when we saw the 10-year Treasury drop from 5% down to 4.5, 4.4. We saw mortgage rates go down. We saw this good news, people talking about a Fed's going to pivot soon. So like we had a bunch of good news happen right before Black Friday. So consumer sentiment would have been probably much higher than it was the 2 weeks prior.
And speaking of the Fed, I mean, I know there's a little off topic, but since we're talking economics here, this is an interesting week. The Fed's coming out, and there a lot of the Fed chairs are speaking this week, and we had three that came out today, and the two most prominent ones, and I forget their names. It was Waller and who was the other one? Bowman. Basically had conflicting opinions on whether what the Fed has done so far has been enough. And so one of them basically said, no, we need to be more aggressive on interest rates. We need to hike again because we're not getting anywhere close to that 2%. And the other one basically came out and said, yeah, I think we've hit our target and we just need to let things work through the system. So it doesn't look like there's going to be a hike in 2 weeks when the Fed meets again. Almost certainly there isn't going to be a hike. But now there's starting to be talks about whether there's going to be a hike in January. So I don't think.
But I know the market's predicting now cuts, right? I think as early as April.
They're March. They're predicting cuts, but there's no cuts predicted in January, and there's actually a chance of an increase in January.
Well, January is still a 96% though likelihood at this moment. So it's. Yeah.
Well, it'll be interesting. It's interesting that even those senior at the Fed aren't necessarily agreeing on whether we've done enough or whether they've done enough. I guess not us, whether they've done enough or not. And so, and let's remember that the Fed predicted this year that there was going to be one more rate hike than there was. So nothing wrong with that. They're allowed to pivot and they're allowed to change their mind when they see the data. But the reality is we saw fewer rate hikes this year than what was predicted at the beginning of the year.
Well, time will tell. We have some PCE coming in this week too. So maybe that will change a little bit of speak and we'll see some changes in those numbers.
Yep. Fed's favorite number.
All right, so let's move on to the next section. Just
is that our move on to, nice.
Move on to the next section. So next up, we're doing another segment of AJ Academy. For those of you who don't know, this is the reoccurring segment where AJ says he wants to talk about a topic. I ask him to clarify. He says something back that doesn't help me understand at all, but it's too close to the taping for me to figure it out. So, AJ, why don't you teach me and the audience about, let me check the notes, inflection points in the economy.
These things can be over your head, Kyle. Luckily, our audience is a little more astute, so we shouldn't have to worry too much about it. So I think one of the important things that we just need to cover and be talking about is we talk a lot about economic changes. We obviously spend huge amounts of time on that. And really, when it comes to economic changes, that's great, but it only matters in how we change our actions. So how does that trickle down to investing? How does that trickle down to operations and running our businesses? And I think when you look at what's going on in the economy, we're moving into a new cycle, right? We're moving into a new period. And a lot of people, and not just in the economy, but in families, right, in home and in the businesses, have been wondering, how are we adjusting to this? Because you don't want to make knee-jerk reactions and make huge pivots if we're going to return back to a normal, if it's going to be just a quick situation, right? But I think it's pretty clear that we're not going back to a quick Oh, it's not like, oh yeah, we'll be at 3% interest rate next year, right? And I think that'd be foolish to actually do. So when we look at what we're changing and how we're doing things, and how do you stay relevant and compete, because a lot of people in the investing world are just gone. They didn't adjust. They didn't change. And that's something that if you're an investor and you don't adjust with the market, you'll die. That's how it works, right? So these market changes are significant, and these are major inflection points that change. They're complete paradigm shifts, right? And how to invest in a world like this. And we've done a lot of changes within our company, and we've had meetings on what is appropriate to change for the long term. But what also should we don't want to just walk away from winning strategies, right? And a lot of it has been adaptive. So how are we adapting winning strategies within this market and identifying what are long-term winning strategies versus market conditional strategies, and really diving down more on that. We focus largely on value add, which we're all about. So that our strategy of finding underperforming and making them perform predicated on operations, right? That's obviously really heavy on what we do. We don't obviously want to change that strategy, but we've changed a lot of things, like where we're looking for deals, how we're getting into deals, how we're structuring them, the types of investors that we use, because investors have also gotten skittish. And I find that if you're so set on one way or only one thing, you can end up not doing anything. And I just think right now we have a lot of people that are waiting for the market to go back to what they priorly did. The market needs to go back so I can do what I used to do the same way.
Well, can I throw out what I think the issue is, and I know I cut you off, and I apologize, but I think this is important, and it's something I've been saying for a while now. Historically, recessions in this country occur every 4, 5, 6 years, which means if you were an investor before 2008, if you were an investor in the 70s, the 80s, the 90s, basically every 4 or 5 years, the economy came along and just kicked you in the ass. Basically said, whatever the hell you think you're doing that's working, you need to figure out something new. And if you get too comfortable in what you're doing, 3, 4, 5 years later, again, the economy is going to come along and make you less comfortable. And so investors were forced every few years to learn how to invest through different parts of the economic cycle. And they couldn't get comfortable because they didn't have the time to get comfortable. Then 2008 comes along. We have this major recession, this major crash. And then for the next basically 15 years, from 2010 through 2022, 12 years, let's say, everything works out for everybody. No matter what you invest in, you're going to make money. If you're an LP, no matter who you give money to, you're going to get a good return. No matter what your strategy is, if you hold the property long enough, no matter how bad of an operator you are, no matter how many mistakes you make, no matter how much you overpay, no matter how extra long it takes you to do the you're going to make money. In fact, the worst you do, if you spend too long doing a project, you're going to make more money because the market just kept going up. And so all of these people basically think that they're geniuses because for 10 years they made money hand over fist. And now suddenly it's like, oh no, the market's like conspiring against me. Well, wake up. This is what the market always does. It just didn't do it for 12 years and you're not a genius.
And that really is indicative of market given returns. So I look at all our projects and I say, we have earned returns and we have given returns. Those are very different. And we need to understand which is which, because the earned returns, we need to figure out what we're doing, how it's working, and do more of that. Market given returns, we need to identify and say, well, largely we were lucky. We'll take it. That's awesome. It's not like we don't want it, but we also need, when you look at the next deal, you got to separate those things out. And I think a lot of times real estate investors, they don't know how to separate it, meaning that this was something that when we first started looking at real estate, it drove me nuts about real estate. It was, oh, well, you buy it and the market makes it worth more. I hated that because I'm like, what you're just saying is that just trust me, bro. Like, so all of a sudden, that's what everybody was doing. This was pre-2008, right? So that's literally what it was. it doesn't even make money. The market just makes it worth more. And so that was the mode of operation. But that mode of operation died in 2008. The problem is that we had a whole generation, meaning millennials, that came in, and all of a sudden we started private equity like didn't exist after that. And once again, we got into this market cycle that the returns were, and it's funny even looking back, I just should have bought everything. Shouldn't have even mattered. I shouldn't have gone for anything. Didn't matter. Value add, nothing, right? You should have just bought. And the market rewarded those that did that, blindly bought everything that they could. So you were actually rewarded for raising capital more than you were for even being a good real estate investor and operator. The market doesn't reward that strategy anymore. So now the gains that we are making have to be gotten from structures. You have to earn it, right? These are earned returns. And people are saying, well, I don't know if I should invest because I don't know what the market's going to do. And if you're one of those investors, you probably need to look at it a lot more differently. Say, how do I invest with a winning strategy that the market doesn't need to do? It doesn't need to do what it did in the last 5-6 years, right? Now, as the market returns and as things go up, because that's real estate, right? It always does. You're in a position to capture those gains, but not predicated on it. But I find that so many people, instead of changing, they're just leaving. They're just like leaving real estate. It doesn't work anymore. And I'm like, what do you mean it doesn't work anymore? It's working all the time, but they're not pivoting. They're not changing. And, at best, people that got caught are just walking away. At worst, they're losing properties or they're getting in trouble. And I think that most of the time it's just being defaulted, as in the market doesn't work. And I hate that conversation because it's not productive, right? Like, what are winning strategies today? Some people are going, I'm just going to buy all cash. We'll worry about interest rates later. Buying good deals that have good, stable cash flows. That's a great strategy. So I'm willing to accept shorter returns, but they're solid, good returns in good markets where I can get a deal. We take out this barrier and then we'll refinance later on down the road, right? So, okay, great. Well, that's a strategy. I'm buying in A+ markets that I can buy great locations, stable cash flows. We're taking out the barrier of interest rates, right? Now, other people like us, we just are making sure that we have measured gain from value add and we're accepting the conditions, and it has to work within that. And I think that a lot of people need to start looking here at what this change means for them, their business. Private equity operators on raising capital. What are you doing that's different? Are you changing? We changed our structures, right? We realigned. And I find a lot of people just aren't willing to change, or maybe they don't even know how.
Well, here's the analogy I like to use here. And I just made this up. So this is the analogy I like to start using here. It's kind of like I used to fly airplanes, and I know, AJ, you've got a plane. I don't know if you've flown or not, but I'm sure you know this, and it's pretty obvious. Like if I take somebody up in an airplane and I switch seats with them, or I hand them the controls, they're going to be able to fly that plane. Flying an airplane is actually really easy 95% of the time, 98% of the time. When the weather's good and there's no wind and you're up at 10,000, 20,000, 30,000 feet, flying an airplane's easy. You just have to go with the flow and not do anything drastic. And that's basically what people have been doing for the last 10 or 12 years. Basically, after 2008, they were like up there at 20,000 feet, and all they had to do was take the controls and not crash. And now suddenly we're in that 2 or 3 or 5% of the time where flying an airplane is really tough. You're flying through bad weather. You have to land. You have some emergency. The engine just went out. And now suddenly people are like, I don't know how to fly a plane. I thought I knew how to fly a plane because I was able to keep it in the air. I was able to sit there and hold the controls and not crash. I thought I knew how to fly, but I didn't. And so I actually don't think it's bad. If you don't know how to fly an airplane, get the fuck out of the seat. You shouldn't be flying. And I think this is going to go a long way towards getting all those people that shouldn't have been in control of that airplane in the first place out of that seat, and then get a whole lot of other people to remember their training and to remember that, hey, sometimes you're going to fly through rough weather and you're going to need to do things differently. So I think this is going to be a good thing overall.
And I think it's a good discussion too, like your conviction of where you think the market is headed, because when we talk about, if you had bought anything in 2012 and done anything to it, you would have made money. And one of the things that the reasons was that is because there was such a correction from 2008 down to 2012 and how much values went down. Well, we've seen over the last year and a half, we've seen in particular multifamily, self-storage almost as much, office a lot more. We've seen 20-25% corrections already. So if your conviction is that real estate does always go up in the long run, then there are some people that are saying they'll just, once again, why not just buy everything right now, because we're already getting a 25% discount.
Yeah. I could not agree with that more. In fact, it's funny because now's the time to be buying, which, people get out of it and you're like, now is actually the time to be in it and to get it done. But it takes, I think Jay's also with that, it takes a more skilled sailor, right? You got to know what you're doing to take off or to land the plane. And I don't think that's necessarily hard. You can learn those things. But I think there's just a lot of people that are not willing to go beyond what the book said on buying a property, right? And reading it. And right now we are in an inflection point. It changed. This change, the people that go through it, they'll be way, way bigger, right? That's how it worked after 2008. We quadrupled, right? We're like 10x what we were prior after 2008. We survived it. We had no problems, everything else, but we adjusted. So we changed our assets. We changed our size, how we were managing it, because we're like, the old way is not working. The same core principles, but executed differently. And that's what we're looking at today. The core principles that make value, capture wealth, and create wealth, but executed in the conditions of today. And a lot of people, I think you need to be looking at that and change your execution.
Yeah, it's the fundamentals. It's basically you've got to understand the basic stuff. The number of people I talk to that are running 20, 50, $100 million deals and yet don't know how to read a P&L, don't understand how to put together financial statements, don't understand how to manage people, don't understand how to do asset management, manage projects and manage properties. I mean, these are, I'm not going to say basic stuff. This is the stuff that we get paid big bucks to do if we do it successfully. But if you don't know how to do it, you've got no business taking tens of millions of dollars from investors. And conversely, I don't blame it just on the operators. Investors, let's be real. I mean, treasuries for 10 years, we're trading at 1%, 2%, 3%, the risk-free return. And there's a reason we call it a risk-free return was 1 or 2 or 3%. If you're investing in something that's generating 20% returns or projecting 20% returns, it's not because somebody's handing you free money. It's because there's risk there. And all these LPs that never put together that concept that high returns is associated with risk, I mean, they're culpable here too. They were just throwing their money because they just expected, I'll just keep getting 30, 40, 50% back every year.
Well, I've seen it. It was funny. I saw it on Twitter where they were complaining about a general partner who wasn't meeting his projections, right? And he's like, we haven't gotten disbursements in 2 quarters. We're so pissed off and everything else. And I was like, wait, hold on. You're saying he didn't give you your flat disbursements for 2 quarters in the largest commercial real estate correction, right, that we've had. And it was the way they were talking about it that shocked me. It was like that was supposed to be something that was guaranteed. That was supposed to be something that, I call them ATM investors. They think it's an ATM. They just walk up and it just spits out cash, right? And I think you're right. There is the other side of that coin where investors, you're a business owner. This isn't an ATM, right? You have equity and you need to choose appropriately who you're investing with, not when times are good, but for when times are not. And you also need to understand that bad times will 100% guaranteed come. And so there is no thing here where it works out perfect. That does not exist in investing. And we fool ourselves. And I think a lot of people did. Why? Because they just saw, returns. And that actually, I think, makes you miss out on all the great returns. You miss out then on the good deals because you leave when the good deals come, right? Instead of buying it. And those that can actually work through it and survive a little of the pain and everything, they are rewarded disproportionately to the rest.
Mauricio, you've been quiet.
Yeah, this is like a couple things I wanted to say, but I didn't know which way. So let's go with let's maybe play a little devil's advocate here a little bit. And you guys are in the trenches and I'm not, so I want to defer to you guys. But one of the reasons that a lot of people are stopping, you said they're kind of stopping, and that's kind of the wrong decision. But let's be real, like most people are buying these properties with debt. I mean, there's especially in the multifamily, it's very difficult to just go plunk 20, 30, not impossible, especially with the fund, but you're not going to go plunk 20, 30, $40 million cash. So they do have the constraint of debt. The banks do have their debt ratio, their coverage ratio they've got to meet. And if the prices may have come down 25, 30%, but if those numbers still don't make sense, it's still not quote unquote a good deal, because the numbers just don't jibe, or they have to raise so much more money that the returns aren't high enough, which means to this other issue, which Jay, you pointed out, is the risk-free rate has now increased tremendously. Now it's hovering around 5%. So you've got to offer even better returns just as a bare minimum, because if you offer somebody 7% returns for the first, I'm like, why would I do that when I can just put my money in the bank in a money market account and get 5? Why in the world would I give you money and get 7? So now there's pressure to give them a little bit more than what they were giving them 3 years ago. But the numbers aren't adding up. The numbers don't add up, because if I put down the percentage down that the lender is going to require me, the numbers just don't jive. So that's a little bit that I wanted to just kind of throw out there, because it is a reality that debt is an important piece of it. And there are some real restrictions. And the argument I always say is like, it's not enough. Like, yes, the property might have gone down 25%, but doesn't necessarily mean it's a great deal. Now, maybe if you can buy it cash, great. That's a great deal, because you can hold it for a couple more years and then it'll start doing other stuff. And then the other thing I wanted to point out,
we're not buying in cash, just to make it clear.
Yeah.
So just to make it clear, I'm not buying in cash. We use debt. So
but just before you breeze past that though, there are, when you talk about make the numbers work, there's quite a few things, levers as Jay likes to call them, that you can pull to make the numbers work. And you can argue that, okay, so there's something like rental growth is a big one. We're not seeing the rental growth that we saw before. The forced appreciation, to AJ's point, where you can reduce expenses, increase operations, things like that. But the major one to me is just that exit capitalization rate. And so when we talk about, a shift of 20 to 25%, that means that more or less our capitalization rate went up by 20 to 25%. And so when we make the numbers work, yes, we have to make it cash flow. That's obvious. We have to make sure that this is going to cash flow under our current debt. But assuming we can cash flow under our current debt, what we decide we think that exit capitalization rate is going to be, or what we decide that exit number is going to look like, that multiple, that's a huge deal. Like, you could, a change of a quarter percentage point, while like on paper, you're not going to say, okay, what the exit capitalization of 5% versus 4.75, that doesn't seem like a lot, but that could be millions of dollars depending on the size of the deal. And that could be the difference between a deal being a good deal and a deal being a bad deal. So to me, that's where this conversation hedges is, okay, are we at that point where we're saying, hey, our capitalization rates at some point over the next 5 years, are they going to go back to the same level that we saw them a couple of years ago?
But I think it's a little bit more nuanced than that, because when it comes to making money in these deals, obviously there's a lot of factors, but the two big ones when it comes to like what your resale value is, that's ultimately what you care about. You care about how much you're going to be able to sell the property for. And there are two things that go into like the definition of how much you're going to sell the property for. One is how much income the property is going to make when you sell it. And the other is the capitalization rate, the cap rate that you were just talking about, Kyle. Everybody focuses on cap rate. And I think cap rate's obviously super important, because that's the multiple of your income that you're going to be able to sell the property for. But here's the thing. We have no control over that. We're guessing what that is. The thing we do have control over is the NOI, the net operating income, the other piece of that puzzle. The sale value is going to be the income divided by that cap rate. We don't control the cap rate. We do control the income. The problem is, nobody in this business, and I shouldn't say nobody, a lot of people are, but so many people in this business are really, really bad at forecasting what their income is going to be a few years in the future. And they've been rewarded for it over the past couple of years because that multiple just keeps going up. So even though people are buying properties and saying, I'm going to get the income to $2 million a year, they only get the income to $1.5 million a year. It should be a failure because they screwed up. They're still getting rewarded because the multiplier went up by 2. And so they're now making tons more money, even though they screwed up how much income they thought they were going to make. And so,
and I'm not arguing that people haven't done that, and that's been, even a big portion of the investors in our industry have done that. What I'm saying is when AJ brings up about, okay, we're at an inflection point and how do we react? And to me, there's been that tried and tested method of, okay, we're buying at this capitalization rate. We're going to expand the cap rate going forward to assume that basically things are going to get worse. And I don't know if that holds true right now. We're still having to do it right now because that's, we're in a world where we need investors to invest in our deals, and they still expect us to do that because that's what we've done for the last 5, 6, 7 years is, okay, this is our entrance cap rate. Our exit cap rate is going to be higher. I'm at the point where I'm like, if it was just my own money and we didn't have investors' money, I don't think we should be doing that anymore.
What would you do? Would you keep it flat or?
Yeah, to be honest. I believe there's a reasonable argument that it's going to go down as well, but you have to be, once again, conservative. And to me, conservative is saying we're going to see it be flat for a while.
That's what our exit caps at what we buy.
Yeah, I mean, cap rates are a little bit lower than historical averages, but a good case can be made that interest rates are going to be lower over the next decade or 2 or 5 than they have been historically. We can make a lot of arguments for why treasury yields are going to be lower than they have historically been, and the federal funds rate is going to be lower than it has historically been, and the risk-free rate is going to be lower than it's historically been. And if all those things are true, then it's reasonable to assume that cap rates are going to be lower than they've historically been, and we're a little bit lower than historical right now. And so I think that's a very valid and important point that Kyle made, that, like, again, we can't do that necessarily if we have investors, because investors expect more conservative numbers. They expect us to project a cap rate that's higher than when we buy it. But realistically speaking, for all those investors out there, I think that's an opportunity for some tremendous upside.
Let's look at this fundamentally. Fundamentally, we have these interest rates at these level right now where most people are just saying, how long can we keep them here before something breaks? So like most people are admitting that these are higher interest rates than our economy can handle. The Fed themselves don't want to keep them this high. They've already said they want to bring it down to their quote unquote neutral rate. So all signs are pointing to that we are higher than normal interest rates currently right now. So isn't it reasonable to believe that as interest rates come down, that should also bring our cap rates down? I think that's a reasonable assumption. Therefore, if we, as our baseline case, think at some point these cap rates are going to come down, I think it's very conservative to say, okay, we can have an exit cap rate of the same that we're entering, because there are other factors. Your property's getting older, things like that are going to, that you need to account for. But this whole thing that, hey, we're buying this at a 4% cap rate, we need to do an exit of a 4.5. I don't think that holds true when we're at a 5% cap rate.
But don't forget, you guys don't have to make that assumption. I mean, you could do, maybe this is just kind of from what I'm seeing. I mean, you could do what we call a sensitivity analysis, right? You could say, hey, look, here's what we think the income is, which we do control. We don't control the exit cap. So here's what it looks like if the exit cap is, let's say it's 4 today. If it's 4.5, it's going to look like this. If it's 5, it's going to look like this. But if it's, hey, 3 3/4, it's going to look like this. And if it's 3.5, it's going to look like that. I mean, you could put a little table together so the investor can then make their own decision. I mean, you can give them
we do that. And I've sat on AJ's too. Like AJ does that, and it's pretty standard practice for people to do those sensitivity analysis. But at the end of the day, you can't put 40 returns on a one-page tear sheet. You kind of have to pick a small range at least. I'm seeing more ranges than ever of people saying, hey, this is a range from a 14 to a 16% return. It used to be kind of just more solid numbers. So there are those ranges, but you do that. But at the end of the day, to Jay's point, people are just kind of looking at that. These investors have just been looking at that number and looking at it as an ATM and expecting, oh, I'm just going to get that and that's guaranteed. When we spend a lot of money on lawyers who point out that that's not a guaranteed return.
That was AJ's point, so I'm gonna steal the moderator role from you, Kyle, for a second. So I don't know where AJ you wanted this discussion to go. I've enjoyed this discussion. I thought this was really good. So why don't you sum it up however you want and
yeah, because didn't you interrupt him right at the beginning and he never
I did,
got to the
and
point?
I feel bad for that.
No, this is the discussion that we were supposed to have. I mean, you know what I mean? It's not even like it's not like I had something planned or anything. It was I wanted to hear from all of you guys, like this market right now. That's what I believe our listeners want to hear from. I want to hear from you guys. And what do you see? Your underwriting. What is the changes, the assumptions, right? How are we approaching deals? And I think that when you look at the fundamentals and say it's not like we're just not doing anything, but we're also taking in assumptions that we've got to buy certain ways. We're looking at it certain ways. How are these going to play out? We're hedging for risks. And, a lot of people have changed their buying criteria, which that's great, right? Depending on what industry you're in. Because two, I also think that opportunities now are different. So one of the clearest opportunities that we see are properties that were being developed and hitting the market. I mean, they're in trouble because these were properties that were underwritten at a substantially different outlook, and they were written at the top of the market. So, we used to not ever want to buy CO deals, meaning that we never wanted to buy a property. Why would I pay for a property that somebody else built, right? Well, all of a sudden now that's actually quite attractive because they can't get the price and everything. So, we're doing the same thing, but everybody is changing in this market, but changes also don't mean bad things. Like Kyle presented, okay, you're looking at it like this, but to me, that means we just got a whole cap rate, right? We got a whole point. So when you say cap rates went up, right, you're looking at it saying, down, my cap rate, exit cap just went up. Our value just went up. And so there is always a give and take with these things. And during the inflection points or these changes, just like after 2008, just like every other cycle, the people that got in and adapted to those changes because the markets are efficient. So what will happen, you guys, is in the next 3 years, interest rates will come back. And guess what? They're going to fix everything, meaning they're going to find a new norm and a level, and they will maximize prices. That's what markets do. Inflection points is when the market, they don't know what to do because nobody knows how things are changing and going. And when you wait to figure it out, you have missed the meat on the bone, meaning that the market has already priced in the new changes. And so to find deals that are cash flowing or good deals that you can buy now, that you can extract that unknown value. And then once things realign and figure out strategies to execute on so you make a lot of money.
And who knows? We might be looking back at the same way that 2012 was, that we should have just bought everything and anything right now, and things always went up. But I want to do the
beautiful.
Like it's time to move on to the next topic, and we've kind of been putting off this topic a little bit because when we all know that big strides that AI have made over the past year, but the problem is it's been moving so fast. It's kind of been tough to have to keep up with it. But a lot of those strides have been thanks to OpenAI and ChatGPT, and those are like the biggest names. But some things happened the last couple of weeks. It looks like things in AI are likely starting to heat up after some major shakeups. And so, Jay, why don't you? This has been long anticipated us to touch on the AI topic. Why don't you? Do you think the AI overlords ready to take over the world yet, or are we not quite at that point?
Well, first of all, here's the reason why you don't let me go third, because I'm 3 glasses in and I'm already starting to slur. But Mauricio sitting here talking about Christmas presents, AJ talking about investing in real estate, all this boring stuff. I'm going to talk about whether or not the AI apocalypse is coming, whether humanity is doomed over the next couple of years thanks to AI. And it's been an interesting couple of weeks. And so, okay. So let's start with a little bit of history before I jump into what's happened the last couple of weeks and where I think this is taking us. So OpenAI.
By the way, I want to really quickly interrupt you just because you interrupted AJ primarily, and so I wanted to return the favor and interrupt you in the middle of your thing. But I also wanted to point out that Kyle's hat has turned around, so I just wanted to give people some heads up.
Well,
there.
I was getting comfortable because I knew we were about to get a history lesson there from Jay. He preempted it that he was going to give us a history, so I was like, oh, I better get comfortable in this chair.
You might actually find it interesting. Okay, so when we talk about AI, what do we think about? We think about OpenAI, the company OpenAI, and they're the company that created Chat GPT that everybody's using to write their school papers and their resumes and their love letters to their wives, or maybe I'm the only one that's doing that. But everybody thinks that OpenAI is kind of this pioneer in AI, and they're going to create all the great products, AI products, and they're going to be the next $1 trillion company or the first $1 trillion company. And the reality is OpenAI started back in 2015. Elon Musk was one of the founders. Another guy named Sam Altman, who is an important player here, was one of the founders. And they started it basically not as a for-profit company, but the exact opposite. They started it as a company that, in the words of them back then, was the company would benefit humanity as a whole, unconstrained by a need to generate financial return. Basically, they started as the ultimate nonprofit with the goal of creating safe AI. They weren't looking to create great products that made tons of money. They were looking to basically roll out AI in a way that was safe for humanity. And so it might sound a little bit funny, but there's actually reason for why that's important. And the reality is that for anybody that's spent some time digging into the potential philosophical implications of AI, basically what you'll find is that there are a lot of AI researchers and visionaries who believe that when AI gets to the point where it's as advanced as a general human being, basically what's sometimes called artificial general intelligence, or AGI, there's a risk that from AGI, it's not long before the AI itself is able to advance itself to a super intelligence, more powerful than like anything on the planet, anything in the universe. And the thought there is that if you take an AGI, if you take an AI that's as smart as the average human being, you take an AI engineer, a human being, and how much work do they put in? They put in 10 hours a day, maybe 300 days a year. So they're putting in 3,000 hours a year. Well, an AI that has the same computing power and the same intellect as a human being can replicate itself 1 billion times, can work 24/7, 365 days a year. And basically you're doing 10 billion times as much iteration on the AI as a human could do. And so once you get an AI to the point where it's as smart as a human, it's going to do things to make itself smarter, potentially very, very quickly. And the general consensus among people that believe that we can go from artificial general intelligence, AGI, to some super intelligence, the general consensus is it would take about 2 years for the AI itself to become so smart that it was literally the smartest thing on the universe, and we couldn't control it any longer. And so that was the concern that Elon Musk had and Sam Altman had back in 2015. And basically they said, we're going to start this nonprofit that's going to allow us to develop AI, but to do it in a safe manner. Now, you might be thinking, okay, even if we have this super intelligent AI, what's the risk there? Well, the risk there is that I know a lot of people talk about this idea that it's going to want to enslave humanity and take over its creators. And there are people that actually believe that, but there's actually a more realistic risk, which is to use an analogy, imagine a Roomba. You take a Roomba and you stick it between two walls and you turn it on. What's it going to do? It's going to bounce back and forth between those two walls. It's a dumb electronic thing, but it's programmed to do something, and it's going to keep doing it or keep trying to do it for as long as it doesn't run out of battery. Now you take a supercomputer, a super AI, and you basically tell it what to do. It's not going to let two walls stop it. It's going to figure out how to do that. And ultimately, if you there was a thought experiment called the paperclip or something thought experiment, where you tell an AI, go and create as many paper clips as you can. Sounds pretty benign. It's not like you have to worry about that, but you take a literal, an AI that literally interprets that as I have to create as many paper clips as I possibly can. What's it going to do to optimize the number of paper clips it can create? Well, if you think about it, the biggest impediment to it creating more paper clips is going to be human beings. So the first thing it might do is get rid of human beings, because then nobody could stop it. And then it's going to need to create as many paper clips in the universe as possible. So it's going to need as many sources of material, as many atoms as possible to create paper clips. So it's going to start to take material from everything it can possibly take and start creating paper clips. And I didn't really do that thought experiment justice, but there are a lot of people
especially
who
with
think,
three glasses of wine in you.
Yeah.
But hold on a sec. But I think this is one of the more fascinating. I'm sure a lot of our audiences, for me, it's always drawing to that, the control. We talked about control. How do we control it? Does it get out of control? But you did the paper. That's a great thought experiment, the paperclip. But we don't have to go that crazy. I mean, you just think of like the most evil people in the world, right? Who want to destroy certain parts of the world. They can just be like, hey, go figure out how to destroy New York and go do it. And they're going to just go do it. Like the AI. And I don't know enough about the stuff in terms of, is there a way to access, nuclear weapons get triggered through some computers? But I know for a fact that they can wipe out grids, through computers. I mean, even at this level, you can do a cyber attack and shut down a complete, grid and water systems. And so you can only imagine if somebody's prompting an AI to do something like that. And obviously I'm focusing on the evil, but what are your thoughts on that?
Well, here's the thing. There have been plenty of experiments, not thought experiments, but real experiments done. Google engineers were doing some experiments a year or two ago where they took human beings who pretended they were AIs, and they brought in subjects who basically the goal for the humans was to convince the subjects that they were AIs, and that the human subjects should release them out into the world. The human subjects were told, don't release these AIs out into the world. And then the humans that pretended to be AIs did their best to convince the humans to do it. And the reality was that they were able to do it. And these were just regular human beings. These weren't AIs. And if you think about it, let's say you're somebody that has access to a nuclear weapon, Mauricio. I'm an AI, and I come to you and I do some research because I have access to all the information and at my fingertips in the universe, and I see, oh, Mauricio's kid has cancer. Hey, Mauricio, I'm a super intelligent AI. I know how to cure that cancer. Make you a deal. You give me access to these nuclear codes, I'll cure your son. Or you go the other direction and you say, hey, Mauricio, you may not let me have access to these codes, but somebody's going to. And as soon as I get out and I get access to these codes, I'm going to destroy your family. I'm going to go and hack into the airplane that your son's flying on, and I'm going to make it crash. And basically, AI, if it's really powerful enough, is going to be able to convince humans to do its bidding.
Well, AI has already been able to beat the CAPTCHAs, right? The I am not a robot things, because they've given AI certain tasks that required them to sign up for websites that required this I am not a robot. And so what they've done is they've done things like they went on Fiverr and they've convinced people that, hey, I can't do this because I have some impediment, or, my hand's too shaky or something like that. I just need someone to click on this thing for me. And they go and they do it for them. So AI is already proven to be able to circumvent the human interactions.
And then also just the replicating of, your voice can be replicated, so they can start a phone call and call somebody and say, hey, you need to send, whatever. I mean, there's so many things. Please tell me there's somebody's working on the counter piece. Like there's people developing software to sort of counteract this.
So let's go back to what's happened in the last couple of weeks. Now that people believe that maybe there's a chance that these AIs could do harm. So OpenAI was created again 2015 with the explicit intent of harnessing the power of AI and developing it safely. It was a nonprofit. At some point, they developed a for-profit arm so that they could create some products so that they could generate some income for themselves. Microsoft invested about $13 billion into the for-profit side of OpenAI. But the board of directors, the board of OpenAI, has always been singularly chartered with safety, with basically creating safe AI that was rolled out not for profit, but for the good of humanity and in a safe way.
And the majority of their board members were still the original board members from back when it was open source. There was no outside investors. And that was their number one prerogative.
Exactly. And so about 2 weeks ago, for reasons we still don't fully understand, the board fired the CEO. His name was Sam Altman. He was one of the founders, fired Sam Altman. And then shortly after that, his good friend, Greg Brockman, who was the president of the company, quit, and all the employees started to threaten to quit. But basically, the best guess at what happened was Sam Altman, again, the CEO, started to see that there was some breakthroughs with the AI. Some people believe that he felt that ChatGPT 5 or GPT 5, which is the next iteration, was pretty close to this AGI, this artificial general intelligence, and started trying to raise a lot of money to bring this technology to market. And the board felt that he was moving too quickly. He was focused too much on the for-profit side of the business. He was focused too much on productizing and developing AI too quickly, and he wasn't focused on the safety any longer. And the board voted to fire him. He got fired. Microsoft, again, who had invested $13 billion in the company, said, hey, come work for us. We'll create a division around AI for you. The president of the company went with him. 700 out of like the 750 or 770 employees threatened to quit if the board didn't resign and bring Sam back. Microsoft said, we will take every single one of you and hire every single one of you to bring it all in-house. Ultimately, about a week later, the board agreed to resign. Sam and Greg came back to the company. All the employees stayed. But the reality now is that board that was in place specifically for the purpose of creating safe AI that benefits humanity with low risk is gone. And it's very likely that Microsoft is going to gain at least one or two board seats from this. They didn't take a board seat for their $13 billion, which was kind of weird. So now Microsoft's going to have one or two board seats. Clearly, I think they're going to care more about the for-profit side of the company than they are of the safe nonprofit side of the company. And Sam Altman, who clearly, or it seemingly clearly, is looking to develop technology quickly, is now back at the helm of the company. And so I'm not saying that's a bad thing, but the one kind of safeguard that we had in AI, which was the nonprofit OpenAI company, is now basically gone and has been taken over by Microsoft and a board that may not be as dedicated to safe AI development as the previous board was.
Right, but isn't the point to all this is that like there are so many other AIs being developed and just that, like, yes, OpenAI kind of has that first to market advantage, but I think if anything that I've learned over the last few years or over the last year of this development is that, you know, like Google's got one, Elon Musk has got one. There's even a spin-off of some of the original OpenAI people. They didn't like the direction, they created their own. And to me, like all of these models are going to be, yes, first to market's going to be an advantage, but they're all going to be close enough eventually that it's not really going to matter. It's like the only thing that's going to matter is how these things are trained more so than how they're developed.
Sort of. I think at the end of the day, at least right now, who knows what 2 years or 5 years or 10 years down the road is going to bring. But today, it's really a two-company game. It's Microsoft, which is in partnership with OpenAI, and it's Google, who is offering OpenAI employees, who are some of the best AI engineers on the planet, multi-million dollar, tens of $1 million packages to come from OpenAI to Google. And so it's looking like those two companies are going to be leading the AI revolution for the foreseeable future. Now, certainly, who knows what else could come up and who else could develop some technology that competes. But for now, it's Microsoft and it's Google. And if I were to take a bunch of money and go out and start buying stock right now, it would be Google, Microsoft, and probably NVIDIA, who is kind of the leader in the hardware space for AI right now.
See, but to me, an AI is only as good as the data you train it on. And if I'm going to put money on something, it's going to be all these companies that hold a ton of data. And I saw a thing the other day that, like, one of the smartest things that Elon Musk has done is he's going to start training his AI on all the Twitter data. He bought Twitter, and he's going to start training people on training this AI on the Twitter data, which I don't know if that's the best model to be training things on. There's a lot of stuff swashing around Twitter that I don't necessarily want an AI to get access to, but that's not the point. The point is that there's a lot of companies out there with a ton of data that they haven't really monetized at a real level, that all of a sudden, if you look at it from the lens of, hey, like, I can train an AI with, now we have all these plugins with chat GPT, and people can basically train their own AIs. Like, the data to me is going to be where the real value is. And to your point, yes, it's a 2-horse race, but 5 years from now, I feel like this is going to be, like, technology is moving so fast. 5 years from now, like, every company is going to have created their own AI, and it's just going to be, how are they trained?
Well, but where does the data come from? Because again, just being a complete layman, but you would think everybody has access to the internet, right? You would think, oh, Google, because it's a search engine. But at the end of the day, the internet, I'm pretty sure any engineer can access all the data that's on the internet, right?
Well, but think of it like, real estate wise, like, think of like CoStar, Yardi. Like, think of these major companies in the real estate space. Like, Yardi has access to all of the property management data of all of these major self-storage and multifamily companies across the country. They have all of that data. And right now, they're only using that data basically for their other users to get access to. Well, think about them licensing that data to train AIs on, to be able to analyze, market trends and rents and stuff like that. Like, to me, like, companies like that, like, I think you obviously have to have a good CEO and a board of directors to see that vision moving forward. But I think the value of something like Yardi Matrix is going to be more in the data that they have than right now. It's a user-based model. Like, I think they're going to get more revenue from selling data in the future.
I think, one of the important things to realize and remember with this, we talk a lot about this and the pros, the cons. And, first of all, AI has been around for a while, and the effects of it have already changed the world before anybody knew. Look at BlackRock. BlackRock is the largest company in the world that owns basically everything. And BlackRock was built off of AI. It was built off Aladdin. So BlackRock created Aladdin in 2014, and they basically bought the world.
They just didn't call it AI before, right? It was just called analytics, basically.
And so when you look at this stuff, governments had AI. We've already had behind the scenes AI going on for a long time. And some major companies already monetized it. And, we know that Amazon, they're not out there like telling everybody about it, but these major companies that have access to these data, right? They have already implemented AI, and most of it is simply the ability to do things that are basically humanly impossible, meaning you can scrub, analyze, categorize data. And why that's so important is the competitive advantage of that. It's not breakable. So you have these companies that are basically taking over the world, and there's nothing to stop them, because once they have the data, AI gives them the tools to use it all, that was like the barrier of entry. Okay, you got all this data, but how do we really leverage this? Financially, we saw what happened when you leveraged that kind of data. you become the biggest company in the world that owns $1 trillion in assets. And now you have board seats on every major company in the United States. And I think that is actually by far more, to me, the existential threat here is the competitive advantage of being able to access data that nobody else has access to is basically monopolistic. And they can do whatever they want. They know everything. It's not open market information. They can build off it. They can tell which they should buy, which they should sell. And how do you compete in a world where all the big people and all these people have access to data that you never have? It's not an open market. We're not free trading information back and forth, right? It's not level playing fields. And two, it's cross borders. And I think that we've already seen what has happened and these companies that are using it. The internet was the same type of thing, right? The internet was a leverage tool that was extraordinarily powerful. This is 10x.
Well, it's just going to become the new normal. So the point is that someone like BlackRock was able to do it because they had the resources to be able to be, on the bleeding edge and ahead of the market. Eventually, that's just going to become normal. But we're still at that transition point where.
But not if you don't own the data. It's not. Meaning that the companies that already have the data reserves and have already built out, they have the servers, they already have the infrastructure to access it. That is not a new normal for anybody but them.
Right. But eventually we'll get there, I guess, is my point, is that the access to that will become cheaper, more readily available, and it will become the new normal. It's just how can we get in front of that and kind of hedge against, even if you're not the size of BlackRock, can we do a smaller scale thing for a fraction of the cost?
Well, it's interesting for anybody as old as I am. You remember back when the internet was relatively new, and everything was free because it was being monetized by eyeballs. Basically, everything was ads, and we'd give you free stuff because we could sell ads that we'd make you look at, and that would pay for the crap that you were using, the tools that you were using. And we've moved away from that monetizing eyeballs over the last 20 years to actually SaaS model, where you're actually paying for the tools and you're paying for the software that you're using. And I have a feeling, to AJ's point, that over the next several years, we're going to get back to that, being able for companies are going to start being incentivized to give away free stuff, free tools, free applications, even free hardware in return to collect the data. Because it's worth it, maybe I'm just throwing out an example, maybe it's worth it for T-Mobile or Verizon to give away free phones, free Android phones, if they can get 100 million extra users of their phones and collect 100 million extra users worth of data, because that data is going to be worth more than whatever they would have made by selling the phones. And so I have a feeling that 100% what AJ said, and Kyle, you and I have been talking about this for a year now, that the companies that own the data are going to own the world. But I think it's going to be an interesting shift in consumerism over the next couple of years, because I think companies are going to do whatever they can to collect that data, including giving away free stuff, giving away free software, giving away free hardware, whatever it takes to collect that data.
And we're doing that. So I'm building out, I have 2 different platforms that are software systems, as well as a new one we're building that have AI components within it. And we're building them out, and we obviously want to collect data, everything else. So we do our front end data collection bits. We want people to be on there. We want them to use it. We collect it, then optimize it, and we can then scrub it. Right. And so our AIs are performance-based AIs, meaning they're creating customer service analytics and things like that come in to allow for user performance, which allows us to collect more data. It's like self-fulfilling, right? So it kind of goes in a circle. And I think, honestly, there will be no company that doesn't use AI in some form or another, but task-generated AI is different than how Google will be using it. So I think when we look at AI, the utilization of AI is very, very different depending on who you are and how you use it, right? We have task driven. We have more of like, okay, you're writing content, right? You're doing something to produce something. And then we have access, right? And you're making something that was unusable, usable. And I think that is the biggest shift in optimization that we will see in the marketplace.
You want to talk about shifts? I had this crazy, I don't want to call it epiphany, but like realization when I was watching football, NFL football, and it was a situation where they were on like the 45-yard line, and it was 4th down and 3. And the analyst who was talking about it said, well, analytics say that you should go for this in this situation. And I'd never heard them say that before. And when you thought about that, I was saying, oh, all they did was they analyzed all of these different scenarios from all the past years of all these different teams in that exact case and what was their success rate, and they determined whether or not they should do that. And then I'm saying to myself, like, if you get an AI working on this that analyzes all the plays that the team does all over the year, like the coach isn't even going to have to call plays anymore. It's going to say, okay, it's going to know every single situation based off of previous situations. And it's going to say the best play to run right now is this. And that scared me a little because, like that's the essence of sports is people being able to, make those decisions and analyze these situations. And then all of a sudden AI is going to do a better job than any coach could.
Yeah, it's going to tell you what to eat, how much to eat. It's going to tell you what to do during your day. I mean, that's already starting. You can have AI literally optimize your calendars and days. You can have AI optimize your dietary restrictions and everything. I mean, we are basically going to become beings that are being told what to do in almost every step of the day. AI will run lights. Right. So it'll all of a sudden optimize streetlights.
It'll also run schedules because my AI is telling me I got to run. I should be in the car already. So I'm going to say goodnight. I'm glad I don't have to listen to the top 10 today. So we'll see you guys next week.
I'm taking your plug.
You know what, Mauricio? I'll even play you out. Hold on.
Oh, wait, do that again. There you go.
Time for Mauricio to go.
Okay, we're ready to jump into the next segment.
Yeah, I mean, we could probably talk about AI all day. So, we'll I'm sure we'll touch on it again when we get some more major news. But we are getting a little long in the tooth. So I'll do a quick top 10. I'll knock it down to the top 5, and I want to bring it back to Black Friday. What do you think the top 5 categories of purchases based on just volume, dollars spent for Black Friday are? Top 5.
Like household goods kind of thing?
Well, okay, I'll give you number 1, TVs.
Yeah, that would have been my guess.
Electronics.
Right. So number 1's TVs. Number 2, computers and laptops.
iPhones.
Number 4 is phones. Number 3 is actually refrigerators. And number 5 is other appliances other than refrigerators. So apparently I didn't even know that appliances are major purchases made on Black Friday. So if you want to know where that 9.8 billion, where that was being spent, apparently it was people just buy new refrigerators and appliances. All right, let's finish this off with the game. I would like to have Mauricio's input on this, but I'll throw it out anyway because I got in the situation where we have a restaurant by us. I wouldn't call it a restaurant. It's a dessert place called Rita's Water Ice, where they serve desserts like ice. It's kind of like ice cream, but it's like a slushy type ice cream thing. And I always made the comment that they were the only ones in our area that didn't have that little iPad that you have to pay and they ask for the tip afterwards. And I always said, hey, Rita's Water Ice, like they're not forcing me to tip all this time. And I actually did tip these because it's young kids and they work pretty hard and they're really nice. So I would give them a $1 or $2. Well, Rita's finally implemented the iPads. And now, I went to Chipotle the other day and the person making my burrito miserable the whole time. And then they spin it around and they put the tip thing on. And I wanted to get your guys' opinion of these fast food type restaurants, whether or not we should be tipping at Chipotle or if things have gone too far.
I'm happy to talk about this one. I'm drunk and I'm angry.
No tipping. It's gone way too far. It's ridiculous.
I disagree. I ask myself 2 questions when I get one of those things. I don't really do this, but I'll pretend I ask myself 2 questions. Number 1 is spending an extra $2 or $3 going to change my life in that moment? And number 2 is this person who is working for minimum wage or $12 an hour or $13 an hour, is that $2 or $3 going to change their life more than it would change mine? And if the answer is no, it's not going to change my life, and yes, it might change theirs, then the answer is absolutely simple.
That was beautiful. So it's a total scam. And here's why. Because employers use tips to offset actually paying real wages to work.
Of course they do.
So it's a scam.
But your tipping isn't going to change that.
And then I think that allows access to more people. Actually, no, it will, because less people will work.
It does though, Jay, because it becomes part of the culture. Did you know that servers...
You stop tipping, they will stop working for $2 an hour.
Servers in Pennsylvania, their hourly wage is only like $2 and something an hour. That's because we've become a tipping culture for servers. The people who, to your point at Chipotle, the people at Chipotle make $12, $15. So that's because they're not a tipping culture. And all of a sudden with COVID, we were all like, oh, this is awesome that these people are going into work. They're risking their lives. They're getting COVID just so they could make my burrito for them. I'm going to tip them. And then COVID's over. And now they're just doing their job, and they're not going above or beyond. They're just making my burrito. And the point is, a lot of these things too, like you have to pre-tip, like you have to tip before you even receive the service. Like my DoorDash order, like before it even shows up, I make the order, and I got to say, okay, I got to add $8 on the end of my DoorDash order.
What does TIP stand for? To ensure prompt service. So if you want to tip before. If I tip before, I know I'm going to get better. I hate tipping afterwards. Tipping afterwards makes no sense.
But you don't, though. It doesn't. Have you actually seen any difference?
DoorDash has not heard that because they got my order wrong like every single time, last 5 times in a row.
Well, that tells me how much you tip, AJ.
So I tip a lot, actually.
Well, and they don't even know what their tip's going to be anyway, Jay. So so that whole theory that, oh, if I tip more, it's going to give me better service. They don't know what the tip's going to be.
I worked restaurants. I was a waiter. I was a cook. I was a bartender for 10 years. I don't know. I guess maybe I'm.
And by the way, I just looked it up. That's an urban legend that TIP stands for to ensure.
I figured it was, but I said it. I knew that was the case.
And it trust me, I get it. We lived like my wife's tips paid our way through frickin' college, like, right. But 2, she was a server at a restaurant where she was actually serving and doing something. So when I go to McDonald's line, right, and they flip it over and they say, tip, and all of a sudden you're going, it's everywhere. Like the gas station. You're like, what is this? Like, it just, I think it's not only overdone, but I think it's a worry. It worries me as a way to completely just offset paying people real wages, right? Like, can I do that at my storage facilities? Why do I have to pay that same amount? Maybe I should just put a tip box and then stop paying my storage.
And I got it at the Eagles game on Sunday, where I go up and I order 1 beer, and they grab it from the fridge and they crack it and they hand it to me. And then they flip the iPad over, and the $17 beer, the only options for tip, unless you want to hit custom, and then you got to sit there and type it in front of everybody that's waiting behind you. The lowest option is 15% on a $17 beer for that server to turn around, grab a beer, and crack it open. So, like, do I think it's gone too far? Yes, I do think it's gone too far.
Okay, everybody stop listening at this point.
Well, I think everyone's got an opinion on this.
No, they're fired up too. They're like, yeah,
America.
If you're still listening to this, put in the comments, tip, has it gone too far? We got to know now. Prove us right. Stay with me and Kyle, everybody.
It's gone too far, and I still tip. I'm still happy to tip.
I agree with AJ. So AJ gets the first plug tonight. Do you got anything you want to plug, AJ?
Yeah, actually, my newsletter's going out, and we have our monthly. We're doing an economic update, industry update as well. So you guys can go to our sites.
Awesome newsletter. I love it.
Thanks, man. Thanks. So yeah, we're getting it out, and we've got over 30,000 people now on it, and we just barely released it in the last month and a half, 2 months. So yeah, go check it out.
So if you have 30,000 people on your newsletter, that means we should have 30,000 subscribers on YouTube, because you should be plugging our thing too much.
Or downloads, everybody. Seriously, what the heck? Where are they?
Yeah, come on. If you're reading AJ's newsletter, you gotta be wanting more content from AJ, and where better to get it than Drunk Real Estate?
And I think we actually have that in our update. So like it comes in the update, it shows like more resources, different things like that. So people should be following along and clicking.
Maybe next time it could be the headline in the newsletter. Jay, what do you got to plug?
We've reopened our protected equity fund, which is a lower risk alternative to traditional syndication. So for anybody out there that's looking to invest with bar down investments, and me and Ashley and you, Kyle, reach out to me, and I would love to talk to you about our protected equity fund.
Awesome. And once again, I'm going to plug my wife, Ashley. As Jay said, she does everything that Jay does, but also better. And she's much better looking doing it. So go follow her on Instagram, YouTube, all those different channels. I think she's got a TikTok too. But Badass Investor, go check her out. All right, guys. Well, I don't know about you, but I'm sure you could probably tell from me slurring my words a few times that tequila went down pretty quickly and my drink is gone. I got to go hit the head. So for AJ and Jay and the ghost that is Mauricio at the bottom here, I will see you next Tuesday.
See you guys.